Hello, everyone. So, this is a weekly review. And, guys, I'm just going to be honest here. Boring wins. You don't really need complicated models. I can say so because I had complicated models. And all I did was, honestly, I went back to the original model framework that I was using that basically taught me how to trade. And I actually went back to look for this book, and it was called Fibonacci Trading, um, Caroline Borodin. Borodin, I think that's how you pronounce it. It's Boroden. That is the book that basically taught me how to trade. Everything in this book is what I currently do now. Um, it's really just based on the book is actually based on Fibonacci, and I'm not great at reading books, but this is the only book I have. Well, I haven't read it cover to cover, if I'm being honest with you. The key part of the book was just around understanding Fibonacci's and trying to have a trade setup, right? Something simple. Now, the book has a complicated trade setup. What I did was I took the one idea from this book. It's called the two-step pattern. And over the years, um, what's happened is I've gone back to it and changed a couple of things. So I'm going to go through that today. I call it a two-step model. I used to call it the fib model. So if you've watched my older videos, you will hear me say the fib model. But this is the two-step model. Okay, it's the same thing. So let's do a review of the trade. One of the trades we had last week. So I'm on the 1 hour right now. So let's go to 5 minutes. Okay, these boxes, if you don't know, are just micro sessions. They just make it easy for me to see the screen. If not, I get a bit lost, a bit lost. All right, I'm just gonna have an arrow here, and right, where did the trade start from? Okay, from here. So if I grab, um, actually, there's no need. Let's just do it this way. There's no need to do a replay. All right, so I'll just make this a little bigger. Okay, so this is the 5 minutes. So as you know, my operational time frame is the 5 minutes. You can use any time frame you want. I just use the 5 minutes just based on my own data, my own experience. I'm not saying you use the 5 minutes, please. I'm just saying I use the 5 minutes. So the very first thing, and you're not going to read this in the book, is you need a starting point, right? You need a point where your analysis starts from. As this is a day trading model, I am not too concerned about the higher time frame. So the daily, the weekly, even the 4 hour, I'm not really that concerned about them. I am aware of them, I'm just not concerned about them. I'm actually more concerned of the 1 hour and the 30 minutes. So the way I see the time frames is the 30 minutes and the 1 hour are sort of partners. So if the both of them are going in the same direction, then I expect anything below that to follow. And then for the higher version of that, I'll use the 4 hour and the daily. So the 4 hour and the daily are going in the same direction, then I kind of expect the 30 minutes and the 1 hour to follow, right? Either to follow or to pull. Okay, apologies if you're hearing that noise, just for some reason the cable, my headset. Okay, so for the week, what we did is the anchor was 9:30. So we always have 9:30 as your anchor, right? And just to make things easy, well, what I'll do is actually just take this off for a second. Hopefully I don't get lost. Okay, just put that back on again. All right, okay, so let's put a line right here. Okay, right. Okay, so that's the 9:30. I'm just concerned with the 9:30, right? That's my anchor. From this point, the anchor, The first step in the model, my model, is direction. I'm not concerned with anything else until I have direction. And I determined that based on the initial parts, the first 30 minutes. We didn't have any direction in the first 30 minutes. We just had price go up and price come down right here, uh, roughly around here. Nothing really. So you just wait. Now I allow for 30 minutes, 45 minutes, 1 hour, and then the maximum is 2 hours. Within that time, you should have direction. So what we get? So initially, nothing here. Price goes back up, takes out this high. So again, no real direction. Then it runs down again, takes out this low. So again, no real direction. Does exactly the same thing. I mean, you can clearly see what price is doing. It's just taking out highs, taking out lows. So no real direction. What you can see here, this is traditional trading, I guess, is broadening, I guess, a broadening top or broadening megaphone, or I'm not sure what people want to call this, a broadening top. Okay, we have that. So I can see that's happening. Now, it's not part of my model, but one, you can call it a problem, a curse, or whatever you want to call it. When you trade a lot, um, you're going to learn a bunch of stuff that isn't really relevant to your model, but it stays in your brain. And when it stays in your brain, it'll force itself out at some point. So obviously, I'm seeing this, and I usually count it. So after five, you get an expansion. So the first move there's in the direction of the trade is your one, then two, three, four, five. At this point, I'm expecting expansion. Even though it's not part of my model, that's what I'm expecting because that's traditional retail trading. Okay, this is a you can see this everywhere in every book, in every website, right? It's very traditional. It's like a head and shoulder pattern. All right, so I'm expecting direction. We then get the direction. Now, look at the time, 10:45. When does it end? 10:20, right? Usually price will stay inside that 30, 41 hour period. That's a good time to get direction. So that's step one. So I can see that direction. Step two is fair value gap. I use the 5 minutes. So I highlighted this fair value gap, which is your IFVG. So it can be in this move or it can be in the move just before it. That's fine. So we highlight this. That's step two. Now you need to do it, well, I do it for all fair value gaps inside that leg. So I've got one here, one here. I didn't worry too much about this one, it's too high. So I highlight everything because I don't know which one's going to work. That leads us to step three. Step three, we want to see an overlap. Okay, so just a fib overlap, just a traditional overlap. I want to see a fib overlap with fair value gap. That's my model. That's it, 3 steps. Direction, fib, overlap. Once I see this, I am now looking for that fair value gap to hold. It must hold. If it doesn't hold, then it doesn't serve my purpose at all. It's useless. It must hold. What I do personally is I drill down to the 1 minute and I'm just looking for a rejection. Okay, this is the most common type of rejection, and I'll show you. So if I drill down, um, let's go to the 1 minute, and if we go here, I don't want to use the replay tool. You can see that candle there. That's a rejection. What I'm looking for is a rejection plus a push, rejection plus a push. I just repeat that rejection. It doesn't mean it's correct. It can come back and take you out if you put your stop loss too tight. I don't do that, by the way. But that's what I'm looking for most of the time. When I say most of the time is what I mean is most of the time that's what price will do. It can do other things, but most of the time that's what it will do, especially in the AM session. You want to see a quick response in the fair value gap. It goes in, rejection, push, and when it pushes, it always creates a small fair value gap. So you can wait for that. I don't wait. I just wait for that push. Once I do that, I'm short. So now I'm short. My stop loss initially, there's a number of ways I put my stop loss. I usually put it at the high here first, just until I set up my target, and then I'll start to adjust it. So I'll put it above this fair value gap, and then finally above this, depending on how fast price is moving. So all I'm looking for is a measured move. I take my fib, I put it at that swing high, and I measure it to there, 100, right here. Okay, so that's where I expect price to get to. Does price get there? It does. But um, what I did actually, personally, because it was Friday, I had other things to do. I actually got, when price got here, I pushed my stop loss right there, and then I got taken out when it went back up a little bit, and then finally hit my target. But I got taken out here. But the main point I'm trying to make is boring wins. Just boring wins. I really tried to make my model complicated, and it was just a waste of time. Yes, it all works, but if you strip it down, not so that it's simple, but so that it fits your modus operandi. In my case, I don't call anything rules anymore because I always broke them. So now I just refer to everything as a framework. So I look at it as a model that it's just a framework, and there's 3 steps that I just have to achieve. That really was it. So I focus on one part of that step, and until that step is done, I do nothing. That helps me out with one very big problem I had: over trading. Over trading. If the model isn't telling you to move to the next step, then you don't move to the next step. You know, if you move to the next step, it's not your model that's the problem, it's you. You're the problem. So this is how I got myself out of over trading. Okay, so it's a combination of your framework and, of course, your trade management, risk management. Combination of those two things will help. It might not eliminate it, but you have a lot of problems to work out, right? The itchy finger effect, over trading, revenge trading. I mean, there's just so many things we we have a challenge with. So that's basically it. That's the review for this week, and I'll see you in the next video.